Veneer, is this what we're seeing? Is the Fed breaking stuff, and do they keep breaking stuff?
Absolutely. I think that's what's going on. I think we've talked about this now for 6 months or so, and I call it it's self-inflicted wounds right now. They went too far in terms of easing. Now they have to reverse. They were buying assets until about a couple of months ago. Liquidity is absolutely horrendous, which tells me that markets are breaking, and it's not been this bad for a very long time.
Veneer, does the market break? Mohammed El-Erian has just written an interesting opinion piece on the Bloomberg, looking at the possibility that market functioning starts to become a concern as well. At the moment, it seems like the market is functioning, but as you say, liquidity is a key factor here, and when it dries up quickly. Is that something that we should be concerned about? Are you seeing any evidence that that could happen?
Yeah, we are. So, market participants watch various measures of liquidity, and one of the ones that is quite important today is the depth in the E-mini futures contract that Abigail was just showing. And that has been declining for quite a while now, but right now it's almost as bad as it was during COVID and maybe even in the financial crisis. So that can give the Fed an excuse because it's not about growth and inflation. If markets quit functioning, it can give the Fed an excuse to actually stop tightening aggressively and maybe even start talking in a friendly way for the markets, i.e. easing potentially.
Okay, that would be a huge, huge shift. Well, do you think we actually see that? And what does the market look like for that to then happen?
So if you look at what is being priced in the market, 2-year treasuries are around 270 or so. The curve inverted just momentarily a few months ago, and then it started re-steepening again. We are sitting right at the lows on the S&P 500, recent lows at least, and liquidity is beginning to really fall quite drastically. I think a sharp sell-off where the S&P falls maybe a couple 100 points again in a day or two, let's say 3,500 or below, I think that results in the Fed maybe just saying, like Esther George just said, we're watching the markets, we're paying attention to it. I think that's sufficient to call into question how far the put is.
She also said that inflation is the priority. So inflation's still high, but the market isn't functioning. What does the Fed do in that kind of environment?
Yeah, so Mohammed said that brilliantly a few months ago. They're trapped, right? The mistake was made last year when they kept buying assets. Now there's no easy way out. So I think the worst outcome, again, as financial market participants, we know that if you can imagine the worst outcome, it can happen, and it sometimes or very frequently does happen, is inflation doesn't come down. So maybe it comes down to only about 6 or 7%. So there's general misery from prices, and then you've got the stock market down 20, 30%. So people rein in spending. So now you've got a double problem, which is lower markets, lack of spending, and higher inflation.
So the other side of that coin, though, and Marco Kolomnik over at JP Morgan has been out in this. He says, we're going to climb out of this hole. No recession. Summer, people are going to do more stuff. We're going to get still more reopening trades happening. China's going to increase monetary and fiscal measures, et cetera. Is that not a white horse?
No, that is. And I think earnings, at least nominal earnings, look fine. Real earnings are not that good. And I think analysts are going to start recalibrating and bringing their earnings down. That has happened in the past 4 crises that I've been in. So minds can change very quickly. But the more important question is not if the U.S. economy is going to survive in the long run. This is a Fed-driven, Fed-caused problem right now. So they can also fix it. And they can fix the markets also by providing liquidity. The question is, what does the path look like from here to there? You might end up having a very sharp drawdown, which could be a great buying opportunity. And then eventually no recession. But right now, things are not looking that good.
Okay, this is a really, really tricky scenario that you're painting here, Veneer, to navigate from an investing point of view. How do I invest in this kind of environment? Do I invest in this kind of environment?
That's a great question, and I wrote a couple of pieces recently on good old 2-year treasuries. 270 yield with roll down and carry, call it 3.25%. You got a lot of convexity because when markets become illiquid, what's the most liquid asset? U.S. treasuries, cash. And 2 years, I like to say they're as good or maybe actually more liquid than gold in that environment. And if yields actually fall by 100 basis points, you make 2 or 3% additional return. The best part is that if we are wrong in it, and we lose the opportunity cost relative to inflation, in 2 years you get your capital back because it's a finite, self-liquidating, finite maturity asset.
It won't that principle, though, be eaten away by inflation?
Absolutely, and that is, so the choice is a very hard decision. Do you give up opportunity, or do you actually give up permanent capital by losing money in the markets? For me, it makes more sense to trust the Fed can bring inflation down somewhat and fix liquidity.
Why not cash?
Cash is fine as well. There's nothing wrong with cash. It's just that in cash you're getting 2.5 or 3% less yield. So I'll take a little bit of yield and 2 years. Yeah.
So from that perspective, if I'm listening to you and I haven't allocated already, can I still do that? Is there still time, or am I kind of like holed up right now until we get some relief?
No, the great thing about the U.S. Treasury market is it's actually on sale right now for whatever reason, because foreign central banks have been selling, and generally bond markets have come under probably historic pressure. But 2-year Treasuries exist out there. I mean, you can buy as many as you want. I mean, not as many, but billions, of course. And it's still a good strategy. As a matter of fact, it's probably higher in yield than where we entered, which was maybe 20 basis points ago. So you're getting in better than where we got in.
The credit markets. Let's just talk about what is happening in credit. In order to come to the market now, you're going to pay significantly more than you would have done 2 or 3 months ago. What do you see in credit spreads? What signals do you take away from credit spreads as they start to widen out?
Yeah, so this is a very interesting conundrum. Part of it has to do with the fact that people are still hoping that credit won't have the same kind of problems like it did in 2008 to 2010. And part of the reason is that interest rates are low and the VIX is low. VIX plus the interest rates drive credit spreads. I think there's a chance that if the stock market makes new lows and accelerates, you might get a sharp spike up in the VIX, which then drives credit spreads wider, and you get a reverse spiral effect where people just can't lean on credit to get indications about what the stock market is going to do. And that is the danger scenario in my view.